Late night, Friday, September 12, 2008. Wall Street, New York. Richard Fuld stared out the window. CEO of Lehman Brothers, 61 years old. His hands trembled slightly. But he knew. He had been left out in the cold. A few blocks away at the Federal Reserve Bank of New York, CEOs of rival firms had been summoned. Fuld alone had not been invited. 48 hours until the weekend ended. That was all the time left for a bank with 158 years of history to survive. That week, Lehman's stock had collapsed. Tuesday alone saw a 45% plunge. Thursday brought another 42% drop. By Friday morning, market capitalization had fallen to $2.5 billion. The trading floor descended into panic. Traders screaming, "Nobody's buying! Nobody!" Fuld watched the scene unfold. 2 years earlier, Lehman's market cap stood at $46 billion. Now it was less than 1/20th of that. But Fuld knew. He knew how this bank began. 1844. A young man from Germany opened a store in Montgomery, Alabama. Henry Lehman. In 1847, his brother Emmanuel joined him. In 1850, the youngest brother Mayer arrived. 3 brothers united, and Lehman Brothers was born. They bought cotton from southern farmers and sold it to northern factories. After the Civil War, they moved to New York and transformed into a financial firm. Their experience in cotton trading had taught them the essence of markets: supply and demand, risk and return. For 158 years, Lehman had survived. The Great Depression, World Wars, countless financial crises. But now, that history was about to end. Why did this happen? Early 2000s. America's housing market entered a golden age. Home prices rose over 10% annually. Everyone believed housing prices will rise forever. Lehman bet on this wave. Subprime mortgages. High-interest home loans to people with poor credit. Normally, this would be far too risky a business. But Lehman created a sophisticated system. Securitization. Bundle thousands of subprime loans together. Securitize them and sell them as CDOs, collateralized debt obligations. Rating agencies gave the senior tranches AAA ratings. Investors around the world bought them. Pension funds, banks, insurance companies. The risk was distributed globally. Or so it seemed. Lehman made enormous profits from this system. From 2004 to 2006, profits expanded rapidly. Fuld was a Wall Street hero, but they had made one critical bet: 30-to-1 leverage. By the end of fiscal 2007, Lehman had expanded to total assets of approximately $691 billion. What did this mean? With such high leverage, even small declines in asset prices would rapidly erode equity capital. Lehman was walking a tightrope, but Fuld was convinced. Housing prices won't fall until that assumption collapsed. Spring 2007. Housing prices began to decline. At first, it was a slight change, but it accelerated. Subprime borrowers stopped making payments. Foreclosures surged. Empty homes began to blanket neighborhoods. The value of mortgage-backed securities Lehman held began to collapse. March 2008. Bear Stearns failed. An 85-year-old prestigious investment bank vanished in 48 hours. With Federal Reserve support, J.P. Morgan acquired it. Problem assets were carved out into a special-purpose vehicle. Wall Street was shocked. Who's next? Fuld knew the answer to that question. Lehman. June 2008. Lehman announced its second quarter results. Loss, $2.8 billion. Fuld told reporters, "Lehman is strong. We will get through this." But the market didn't believe him. The stock price fell further. Fuld desperately searched for buyers. Korea Development Bank, Bank of America, Barclays. Everyone showed interest, but no one bought. Lehman's losses were too massive. Wednesday, September 10th, 2008. Lehman announced its third quarter results. Loss, $3.9 billion. The market panicked. That evening, Fuld sat alone in his office. Outside the window, dusk settled over Wall Street. His hands trembled. Late night, Friday, September 12, 2008. Federal Reserve Bank of New York. Treasury Secretary Henry Paulson and Fed President Timothy Geithner assembled Wall Street's CEOs. Emergency meeting. One agenda item. Save Lehman or let it die, Paulson said. The government will not provide public funds. The private sector must solve this. Meanwhile, on the 31st floor of Lehman headquarters, Fuld waited by the phone. But no one called him. 6 months earlier, the government had rescued Bear Stearns. Why wasn't Lehman being rescued? Paulson was making a political calculation. After the Bear Stearns rescue, backlash from Congress and the public had been fierce. Saving bankers with taxpayer money? Moral hazard. If the government bails them out, banks will continue taking reckless risks. Paulson made his decision: make Lehman an example. Over the weekend, negotiations continued. Bank of America, Barclays. But Saturday night, Bank of America withdrew. They had decided to acquire Merrill Lynch instead. Sunday morning, Barclays also withdrew. British financial authorities refused special approval. Fuld lost his last hope. 2 a.m. Sunday, September 14th. Fuld sat alone in his office, clutching the phone. But no one answered. Monday, September 15th, 2008. Before dawn, Lehman Brothers filed for Chapter 11 bankruptcy protection. At the time of filing, assets totaled approximately $639 billion. Liabilities approximately $613 billion. The largest corporate bankruptcy in American history. 158 years of history ended. That day, the world shook. New York Stock Exchange. The moment the opening bell rang, stock prices collapsed. The Dow Jones fell approximately 500 points that day. The decline rate was about 4% at closing. London, Frankfurt, Tokyo. Markets around the world descended into panic. Lehman's collapse paralyzed the entire financial system. Credit froze. Banks stopped lending to each other. Who will fall next? Everyone became suspicious. AIG teetered on the brink of collapse. The world's largest insurance company. This time, the government rescued it. The Federal Reserve established an emergency lending facility of up to $85 billion. Why wasn't Lehman rescued, but AIG was? Paulson said. AIG's failure would collapse the global economy. But it was already too late. Lehman's collapse had pulled the trigger. In October, governments around the world mobilized. The United States created TARP, the Troubled Asset Relief Program, with up to $700 billion for capital injections and other measures. European nations also rescued financial institutions. But the impact on the real economy could not be stopped. The world plunged into the Great Recession. U.S. unemployment reached 10% in 2009. Job losses during the recession reached millions. National home prices fell sharply from their peak. Millions of families lost their homes. The economic losses from the crisis varied by estimation method, but inflicted incalculable damage on the global economy. One bank's failure broke the world. 2010. The Dodd-Frank Act was enacted. Major strengthening of financial regulations. Increased capital requirements for banks. Leverage restrictions. Transparency in derivatives trading. Similar regulatory strengthening occurred worldwide. However, regulations weren't uniform. In 2018, the U.S. raised certain regulatory thresholds. The 2023 crisis of Silicon Valley Bank and other regional banks refocused attention on supervisory strengthening and capital regulation reform. Lehman's collapse changed the financial system. But questions remain. Today, Wall Street has recovered. Stock prices are reaching all-time highs. But some point out that risk has merely shifted form from banks to shadow banking and continues to grow. And Lehman's lesson has not been forgotten. Too big to fail. Lehman was too big. But the government let it fail. As a result, the world learned. That one decision can collapse the global economy. Yet in 2023, During the Silicon Valley Bank and Credit Suisse crises, governments moved to rescue them once again. Too big to fail lives on. So let me ask you, history only tells us outcomes, but those living through it don't know the outcome. If you had been Paulson in September 2008, would you have rescued Lehman? The risk of creating moral hazard by saving one bank versus the risk of triggering a global depression by letting one bank fail. Which would you choose? Share your thoughts in the comments below. Thank you for taking this journey with me. The collapse of Lehman Brothers stands as one of the most significant events in financial history. On this channel, we explore the decisions of history's giants and the lessons we can learn from them. In the next video, I want to bring you wisdom that serves your life. Hit subscribe and turn on notifications so you don't miss it. I'll see you in the next story.